We have a pretty
Hey
good
guys.
group joining us today. I think everyone's excited about cap tables. All right, Guy, over to you for a quick intro.
Thank you. Great to see you everyone here. My name is Guy Israeli. I'm the managing director of Techstars Tel Aviv, and we invest and help AI and deep tech founders build awesome companies and become global success.
Awesome. Thanks, Guy. Over to you, Lee.
Hi, my name is Lee. I am the investment associate for both Techstars Tel Aviv and London. So with me today are my two MDs, and I support both of their investment theses, which, as Guy mentioned, is surrounding AI and robotics. And similarly, the London program is also looking at infra, deep tech, and AI-based solutions. So over to you, Georgie.
Hi guys. Hi everyone. Great to see so many faces. I'm Georgie. I'm based here in London. So my background is I was an operator, a founder. So I've raised over 20 million in VC funding. Have gone through an exit. Have gone through one complete failure and one middle of the road. So kind of seen all three scenarios. And then I flipped over to the investment seat. I was an investor on in a fund called Target Global. It's a big pan-European Middle Eastern fund, 4 billion in AUM, has 28 unicorns. So kind of learned both sides of the table. And I'm MD here at Techstars. My joy in life is the early stage and working with founders. So I kind of moved from later stage down earlier. And we are really focused here in this program at doing two things. One, working with founders to provide the quickest route to product market fit. I have been a founder completely on my own devices, raised 1.2 million, and then was just in a room with two others, and we were trying to figure out what to do with that funding. And I really wish I had gone through something like Techstars with the community, with mentors on tap. And so, yeah, I decided actually this was the stage I wanted to work at. So that's what we're going to be doing in London. And then the second part, other than PM product market fit, is we will be helping companies to demystify venture capital, not just how you get funding, but actually how you're pretty discerning and you pick the best investors for your board, for your industry, and so on. And that's what we focus on here in London. So if there's any aspiring founders out there, we are recruiting currently for 10 amazing companies to come and join us in March in London. It's going to be fast and competitive, so you'd have to be ready, but please think about applying. November 20th is the cutoff. So yeah, London Accelerator, check it out.
Awesome. Thank you. Thanks so much. All right, I think we are ready for a presentation. Just 1 second. All right, Lee, over to you.
Awesome. Are we sharing full screen here? Okay, I think we can jump over to the next slide and probably share full screen. Awesome. So as you guys all saw in the agenda, we're going to be discussing cap tables today. So what does that mean? We'll be breaking down the basic structure and components, discussing why it's important and their role in fundraising, equity management, and company growth in general. Key terms and concepts regarding dilution, ownership percentages, stock options, and more. And then overarching how to read and interpret a cap table and the skills and the structure to comprise one. We can head over to the next slide. So ultimately, what is a cap table? It's a document that outlines the ownership structure of a company, and this is essential for our application. As Georgie mentioned, London applications are already open, or any Techstars program, so it's crucial that you have one. It's essential for managing equity and understanding how the ownership is divided. Generally, it consists of the shareholders, the number of shares they own, the percentage of the company each shareholder owns, and the equity distribution, whether that be amongst founders, investors, employees with stock options, the Techstars Accelerator program, hopefully. So these are all things that you'd want to have included in your cap table.
Specifically, I would say the key component of cap table are the shareholder names. And I would advise you to be very, very accurate on the names. No nickname, full accurate name. Me as a founder, myself, I've been to in a case where two lines seems the exact same name, which are many interesting conversations with the investors. So keep it shareholder names. Who owns those shares in the company? Number of shares that they have, keep it accurate. Exact number of shares. What percentage do they have out of the total pool of shares in the company? The type of shares. We might not have time to discuss today the type of shares, but type of shares can be common shares, preferred shares, options, convertibles. All of these should come into place. The valuation and the price per shares. It helps to determine the value of the ownership. And vesting schedule for those who are under stock options.
Cool. This over to me. So why are cap tables important? As we mentioned earlier, this helps with fundraising. So investors can better understand how the equity is distributed amongst the company and the exchange that they'll receive for the funding that they put in. This also helps manage equity for yourself over time and seeing the dilution that takes place. In addition to those two elements, it also helps you account for company growth and assessing how new fund rounds or stock options will come into play and affect your current ownership. In addition to all of the above, it's a requirement for legal and compliance when you are documenting for tax purposes, reporting, legal purposes, so on and so forth. Obviously, you can get into the nitty-gritty depending on the country you're incorporated in, so I can't speak to that. But each company has its own regulations in terms of reporting. And also for investor relationships, before approaching any investor, it's essential to provide them with the transparency of the ownership within your company. This helps to build trust with not only potential investors, but also the current investors that you may have. So these are just a few of the main reasons why it's important to have one.
Cool. So talking about the key terms and the concepts to know. So first of all, I remember thinking back to when I first dealt with my cap table, and let's not beat around the bush here, guys. Like, cap tables are not fun. If you love cap tables, you're definitely a different human being to me. I think in the first instance, my first company, I saw a lot of the jargon and I saw a lot of the kind of complexities, and I stayed away from it. And actually, that was a mistake. I ended up with a super unstructured cap table, and I didn't track things accordingly. And I can tell you, it is a nightmare later on. So please do get comfortable with these terms and concepts. It's dry, but it's your baby. And knowing who has ownership of what, all the different types of ownership structures, it's really key. And you would be so surprised as an investor. We were coming in on kind of like Series B rounds and looking at cap tables, and generally they were a mess. So don't assume that you will be good at it without much work. You need to get okay with these, because it'll save you money and a lot of time and a lot of stress later on. So a couple of the key concepts to think about. So dilution, that is key. That is the key thing that founders need to think about and often overlooked. And really important. So get comfortable with dilution. Think about the impact of how you price your round, of giving equity away to advisors. It's going to dilute you, and you need to stay, venture. It's a long journey, and you need to stay incentivized for a long time. So really, really important. Then obviously the ownership percentage is the proportion of the company owned by you, shareholder, and it's expressed as a percentage. So stock options, this is how you are going to convince that amazing coder to come and join your early stage company, is going to be with stock options. So this is the right granted to employees to buy shares at a set price. They can come on with an agreement pretty cheaply, and then over the vesting schedule, they will be able to actually exercise those rights, take ownership in the company, and build the rocket ship with you. Preferred shares, so there's lots of different types of ownership structure and class of shares. So preferred shares is different to common shares. Preferred shares is typically what will be given to investors when they invest into your company. Really understand these, because what it means later on in your business is who has priority when you actually hopefully exit the business. But they will be different classes of shares to what you as a founder will own, and the employees. So yeah, get comfortable with the two typical classes of shares. And then fully diluted shares, so total number of shares, including outstanding options, your warrants, and your convertible securities. Yeah, as I say, not going to light your world on fire, but really, really important. Also, another note on this is, when we're looking at early stage companies, when you go into seed and you can see a comfort with the founders, the way that they handle negotiations on their cap table, and they feel very comfortable talking around these terms, it gives a really good indication to investors that these are people who care about the finer details, and are, kind of can look at the commerciality of the businesses, which is a really good thing. So then let's look at how to interpret and read a cap table. So look, there's lots of different ways, and there's lots of different platforms that you can use. This is just a very, very simple one. Another thing I'll say is using there's lots of platforms out there. An automated one, it will make your life easier. I don't say that because I'm tied to anyone. I just say that because I've dealt with the Excel sheets. So looking at John and Jane, so they are co-founders with split equity here. So they own 130 million shares, which is equal to 43.3% of the company. They had originally owned 500,000 shares and 50%. And so what we're looking at here is what happens after investment. So they have been diluted after the investment round. So this is the thing, when you actually play around with your cap tables and what it means every time you fundraising is helpful, but it does dilute you every single time, which is not great for founders. So just play around and see every time you raise money what it does to your dilution. So here they have been diluted, not by very much. They didn't put in any capital themselves. So you can see that they didn't put any of their own money in, but their value is still significant. Then you can see what happens when Techstars comes in. So Techstars invests 120,000, which isn't going to do anything major to your cap table because it's early stage. It's not this kind of huge round which dilutes you massively, and they're just taking 6% ownership, or 18 million shares. Their investment, so it's 120,000. Their ownership value, you can see there, will be on $0.01. And that is equal to then 180,000. Then you can see investor A has come in, and you can see the 10% ownership, and that's 30 million shares. So then total, you can see down at the bottom is 300 million shares. Really, really simple. Again, when you're using a platform, this will just kick it out and you'll be able to play with a lot of them and you'll be able to see the ownership. It's pretty straightforward. I think one note on this is this will get a little bit more complex as you go on. Your employees and your angel investors, etc., all will be represented in your cap table. Your cap table is that core document to always come back to see who owns what, with what terms, and so on. So yeah, this is super simple. So finally, on the conclusion, as I've already said, cap tables are really key for understanding ownership, for making informed decisions. So do you need to open up the stock options pool because you now need to bring in more employees, or win a really top talent? And also, can you do within your preferred shares, what are the terms that investors will be looking for? Really important to read all the fine detail. And then the other thing I will say about this, is crucial. It's crucial for fundraising. If you have a cap table where you have given away too much equity in the very early days, so you haven't been particularly discerning with regards to giving equity to advisors or to founders who didn't have the right vesting schedules and have left the business and so on, it makes it very difficult to get a very good investment firm on board. They really look at founder equity as a very key metric for whether this company will go the hard miles. And so please be really mindful that you want to have a clean cap table, one where you are incentivized correctly and you don't have a bunch of advisors there who've taken 1% here, there, and everywhere and are now not involved in the business. That's not going to serve you very well. Yeah, cap tables, boring but important. That's a key point.
Yeah, and as Georgie mentioned, there are many platforms that you can use. Here at Techstars, we have a template built out that Jessica will share in the chat here with you. In here, you can put in your own numbers and play around with it. It's a lot more thorough than what we shared quite simply in our presentation. So here you can definitely enter a lot more information, utilize this at your disposal. In general, there's a lot of Techstars tools that you can access through our website, and this is just one of them. So I encourage you all to copy this template and use it at your disposal. And I'll let Jessica get back into it.
Amazing. Thank you all so much. That was a great presentation. I'll go ahead and stop sharing my screen and we can go over to some questions. If you have any questions, please use the Q&A button because we will reference that. I'll try to find the ones that have already been in the chat, but please use the Q&A button. It will help us out a lot. Also, I wanted to quickly just share the template with everybody so that way you all have access to that. Okay, great. Awesome. All right, so I will pull up the questions now. Okay, so when it comes to creating the cap table, who is typically the first person in your company that makes the cap table? Is it the founder or is it somebody else on your team? Are there any recommendations for that?
I will jump on that.
Oh, you go for it, guy.
It's you, the founder. There's no one else. It's only you, the founder, creating probably something very simple at the beginning as a cap table. You own it.
Great, thank you. When it comes to the framework of giving equity to your co-founders and your super early stage, let's say that you have like 4 employees that are part of your startup, how do you determine how much equity to give them? Is there a guideline for that?
So maybe Guy wants to talk about it he's gone through this a few times.
I've gone through that a few times again as a founder. It's more art than science, I would say. There is not like a formula that give you the exact number, but there are statistics about how much you give to your founding team, which is different than your co-founder. Your co-founder, you don't give shares. You actually decide with them the pool of shares that you have as co-founders. But then you have the founding team. It's a hard answer to say. It goes between 0.1% vested to 4 year up to 1.5% vested to 4 years. Really depends on the type of employee. When did he join? How much did he suffer with you through the mud of having no funds? But there are a lot of common statistics which you can very easily Google.
So, Guy, you mentioned you determine with your co-founder like how many shares. So, do you have any more insight on that? I see a lot of questions of like how many shares should you start with, or how do you decide how many to make? Because it seems like there's a lot just in that example, right? You're in the millions. So, how do you know what the right amount is?
The first time I created a company very naively and put 1,000 shares, which was a very stupid thing to do because obviously you will have many more shares. It's probably an answer you will ask, you will get 3 different answers from 3 different lawyers. But generally speaking, by the millions, I would say, let's say you are 2 founders, then 10 million shares, roughly. It can give you a lot of bandwidth to do like 0.01%. It actually has a number by shares. You can actually divide it. But don't go into the billion shares at the beginning because then it's hyperinflation in a way that you don't want to go there.
Yeah, 10 million is a good standard number to begin with.
Okay. And is it because in that 10 million range, you have like a lot of flexibilities to offer with different investors? Is that why it's the standard?
Well, as you saw, it was priced at 0.01 cents. So it's easily divisible by that. So when you go to incorporate, they'll generally advise and you'll start out with that share distribution unless you request otherwise. So I found that anyone that just goes to incorporate, this is speaking to like a Delaware S corp. Obviously, each state, each country has different rules and best practices. But yeah, that's seen as a general practice there, and that can always differ upon your request and preferences as a founder. There's not one shoe size fits all answer for this question.
Great, thank you.
It also helps with it's a small side point, but actually, so 10 million, it does allow you flexibility and so on, but also when you are incentivizing teams to come on board, actually being able to talk to how many shares they own also is, it's also a hook as well. And so a lot of founders, rather than having like 130 shares, because you have 100, etc., the bigger the number, it does just also add to a sense of ownership. But that is, as I say, just a very small point. It is about kind of giving flexibility because you are coming in at a very lowly priced round.
So once you determine your number of shares, can you change that at any point? Is it something that, like, how does that work? Because I see a lot of questions coming in of like, why is it that I'm determining it at, the 10 million versus like just making it simple math, 100 million, or, why is the number set at 10 million specifically?
I can see Guy is going to answer it.
I would start with a disclaimer. I'm not a lawyer, hence I cannot give you legal advice about how to do it. After saying that, I would say everything legally wise you can fix. The question is how much it's going to cost you to fix it. With that, I would say you don't want to mess and go back and change the cap table again and again, going backward. I didn't have enough shares. I need to do all the procedure with the legal and pay them more fees that I don't want to pay them. Keep it simple. So 10 million is just a number. It can be, you can decide that you have 20 million, you can decide that you have 5 million. It needs to make sense. It needs to create the flexibility for you to give shares to or options to employees that are vested across 4 years. I mean, imagine that you can give someone only 4 shares because you have too little shares and it's vested to 4 years. That person will receive 1 share per year. It's kind of a joke. Doesn't look that well. So you want to keep that flexibility. And again, it always can be modified and changed. And probably many companies do change that. But it's require you to go through legal. And you're ready or not. So keep it simple.
Yeah, and as you go through the rounds, when you look to authorize more shares, that's when you work with your legal team and they advise, and you will also work with at every investment round. If you are looking to authorize more shares, particularly this happens like Series C plus, you will then work with the VC fund, and it'll be kind of part of the terms of the investment round, because you are going from say like 100, 200 employees to then you are going to scale to 500, and that's the point at which you decide with the fund, we need to have a bigger option pool and so on. So it does become, it becomes more complex, but at that stage you also have more funds to have good legal advisors around you and your investors too. Another note on that is, yeah, I mean, I wouldn't look at seed, pre-seed. I wouldn't be worried about that. Start with the 10 million. And as we go, you will just see how it evolves. It is actually, pretty straightforward, but the key note there is it is actually a negotiation point. So make sure to do the work with your lawyer and thinking before the round, and before you kind of agree with anything on the investment side, because it can impact you and your dilution. So you don't want to agree without knowing what that means. But again, it's something later on, and if you're having that problem because you got in Series B, Series C, it's a good one.
Awesome, thank you. Is it advisable for founders to be directly on the cap table, or should there be another entity who owns the shares?
And you need to be on the cap table.
What was that?
Yeah, founders are on the cap table. It's your business. That's what I've always personally seen. Curious to know if Guy has seen anything else, but we would always look for a founder and ensure that they have direct ownership of the business.
You as a founder must be on the cap table. Investors will not invest in you if you are not in the cap table, and there is a middleman, meaning a legal entity between the investor and you, which called some random third-party company. You are the founder, you are on the cap table. From every single perspective, from a founder perspective and from investor perspective.
Okay, and then along those lines, is there any possible way to avoid dilution when it comes to the cap table as you add more investors?
Not if you want investment.
Sorry, Leah, I couldn't hear you.
I would say that the simple answer is not if you want investment. Any investment put into the company, unless it's your own, is likely to dilute you. But as people like to say, would you like to own 100% of $0, or would you like to own 20% of $1 million? So at the end of the day, usually the investments pan out, and investments allow you as a company to grow and scale and increase your revenue. So I think that's the ultimate goal of any company, to add value and to increase their revenue, as opposed to owning the most shares in the company.
Yeah, and I'll add to that. So, as part of venture capital rounds, they are equity based and they are then inherently dilutive. However, You should also look at the early stages at grant funding. So there are lots of non-dilutive early stages of capital which are readily available. We do a lot of work with founders here in Techstars to show them how to access those, how to write grant applications and so on. I know that we got about £400,000 of grant funding in total, which was really game-changing for allowing us to reach our milestones before going for another price round and dilutive round. So yeah, where you can get those, provided that the application period, application effort is not too taxing, I would definitely always recommend that founders in the early stages apply for those.
Oh yeah, that's a good point about grants.
We actually have another question about dilution. Can you explain more like how dilution works? Are people on the cap table diluted equally when it happens?
I will jump on that. Every time you raise funds, let's say you have 10 million shares, and you raise funds, you issue new shares to the investors. And let's say you issue then 2 million shares. Now you have 12 million shares in the pool of shares. That means that your relative part in the total amount of shares is decreasing. Hence, your part in the company is decreasing. That's how dilution works. The more shares you issue to investors, to employees, the more share there are, the smaller your part.
Awesome. Thank you. All right. There's a lot of questions coming in, so I'm trying to find the ones that are going to be the most relevant for everyone in this group. Okay. So when it comes to the co-founders, can you change the amount of equity over time if, for example, some of the responsibilities change between the co-founders that are leading different projects, or if there are some disagreements that come later on, can that be changed?
Yes, there's several parts to it. So I'll do a beginning and then I'm sure Guy can add to this. So yes, there are. So sometimes you have a scenario in which you will have, say, we'll call it lead founder, who maybe has generated the idea, perhaps has, been in university, created some IP, etc., and then goes out to build this venture, looks for, say, a co-founder, right? So that founder comes in, founder two. In that instance, you've got the equity split will most likely be not 50-50. There's still trust to bring on board. There's many factors. In that case, they will come to an agreement of a split that feels right at that time. But 2 years in, founder B is a true co-founder, has displayed that they are in this for the long haul and really, really important to the business. And so then the board it'll be taken to the board and it'll be an agreement, provided that you have done a sort of investment round and you have a board that needs to agree these things. And then the board can agree that actually the equity of founder B is raised. However, say if in another example, if you have a founder who has is a bad leaver, for example, leaves early. So typically you will have a vesting schedule. So you might say, okay, Guy is going to have 20% of the company, but this is going to be over a 4-year or 5-year. There's actually a hot debate around how many years a vesting schedule should be for founders. Some people say 10 years, which is crazy in my mind, but anyway. But yes, so Guy comes on as my co-founder. And then actually turns out that Guy has thought of something else amazing he wants to go and build, and he's decided he's going to leave. Guy doesn't get that whole 20% up at the beginning. It typically will work they will still work to the cliff. So they'll have the 1-year cliff. So his equity starts vesting after a period, and he has to earn that 20% over those 4 years. if he leaves after the year 2, it's only 1 year of vesting that has actually has of equity that he has. So there's lots of ways that equity will kind of shift, or you will earn it, and so on. There's a lot of ways that you can safeguard, and actually investors are really they're pretty particular that founders are held to a vesting schedule, so that they're incentivized to carry on. But yeah, I think the really important piece here is in anybody who's on your board, provided that they're a proper investor, it is in their interest that you are motivated. And so if you believe that a great person needs more equity to stay and stick around and make this business bigger, you can always increase their equity. So that's a general principle. How you do it is there's several different ways.
From my experience, there are two types of radical changes with founders. Either founder leave the company, or either founder join late to the company. You might start your journey as 2 or 3 co-founders. Looks like a great relationship at the beginning, but sometimes things doesn't go as well and one founder need to leave. I would advise you first, perhaps it's kind of a side related topic to cap table, have a founders agreement. How do you deal with such case with one founder leave? And what are the methodology and the vesting and so on. There are also cases where investor come and invest in you, specifically in early stage, and say, okay, I invest in you, the people, the founders, to build that business. There are hardly any revenue now, I believe in you. But if I'm putting my money, I want you to stick into this company for at least 5 years. Therefore, all your equity that you have now will be vested up to 5 years, and with a cliff and so on. To protect my money as an investor, investing in you to build that company. So I've seen those as well. And then the second scenario, when founders is joining the company. So going back to the first scenario, 2 founders, 50-50 each one. Let's say there is one founder who holds 100% of the company. The company is already registered out there. In not many jurisdictions, you can suddenly give 50% of the company without implication of a very high taxation. Again, disclaimer, I'm not an accountant. And therefore, there are mechanisms that are invented either to give you shares as the company grow. So you basically, as a co-founder growing, you have agreement with the board that you will grow, or that you will not, you've given shares, but you will not be diluted in the next round when it is. There is dilution protection. So there are various mechanisms which are very tactical how to address it. If you have such case, write us, and either we share our experience, but most importantly, we will refer you to go to your lawyers and ask what's the mechanism, how to deal with that.
Awesome. Thank you, Guy. And thank you, Georgie. So can you create a lower class of shares that don't come with a vote or a seat on the board?
Yes. The short answer is yes. Probably the shares, there is a board, but the board is given to lead investors. This is not necessarily related to the type of shares that you have. That's a separate thing. In terms of type of shares, there are shares with no voting rights. Normally, these are shares that are given to employees of the company. Any option, any stock option that you give to employees, they have no voting rights, even though they might be converted into common shares. And any investors who invest in you will want shares that have voting rights. Even if he has 1% in the company, he still need to have some voting rights.
Okay, great. Thank you. So if you're part of a group of investors, is it common for the cap table to be shared with all parties? And how often should the cap table be shared?
Well, first of all, if this question is from is this question from the investor angle as like as an angel?
I think so, but
Yeah.
please clarify in the chat, Dan, if it's not.
Well, actually, we were quite protective of our cap table for many different reasons. We also had a lot of angels who operated that way. We had a very big angel cap table. I personally haven't not seen it shared widely. But Guy, I would be curious to know, these things are subjective. They're very, I think, different between different companies and different founders. We were careful on it for certain reasons. Guy, what about you?
The short answer is depends. If there are current investors of your company, it really depends, I would say. Sometimes there are privacy matters of some investors and others, but essentially it's a private company and some of the data is private. Maybe you can go to the register members and see by how it is registered and figure it out from there. Not all the information is shared.
Okay, and how do you incentivize which shares if they currently do not have a high value? So, do you have any different tips to share how they could be valuable in the future?
I mean, that's your storytelling, right? So that's as a at the earliest stages, in your first few rounds, those shares are not going to be particularly material to an individual, but the future value of them are uh, incredibly so. So to be a great founder, you have to be able to hire great people and get people to take a big risk and to leave whatever path they're on and come and join yours. And so it's all about where you're going to go, what the vision is. It's often an overlooked piece, but that's, for people who joined, I remember Expensify pitching a job at, I think, like their Series A, Series B, and it was definitely a regret not taking the role because they said we will IPO with 100 people in this company, and they did IPO with about 100 people in that company, and every person on that team became a millionaire. But they were pretty bullish about that pretty early on. And they said, would you like to be a millionaire at 30 and, take a year or two off and become an investor and do what you want to do? And that was pretty compelling. So yeah, it's the future narrative. I'm sure you've convinced many people to come and join your ship before, so maybe you can talk to it.
The best way to answer it is this question is simple. Build an awesome company and everything around it will be awesome.
I love that. Simple, but difficult at the same time, right? All right. So when it comes to all of your shares, is there any advice about leaving some of them unallocated or do you have to account for all of them? So that way, that question really comes from like, if you have future investors that you want to work with and leaving those unallocated shares so that way you can divvy them out to those future investors.
So say if you start with 10 million shares at the beginning, what we typically see is you would allocate about 9 million and then you would leave 1 million for stock options for the first, but this changes at every single round. So you only need to think about it at the beginning. That's the kind of usual split. Again, please work with a good lawyer. They will show you all of this. Like don't do a seed round or a pre-seed round without a lawyer involved, and they will advise on all of this. Again, it's you deal with it at kind of every stage. So the allocation of shares is pretty simple at the beginning. That 10 and 9 is a good rule.
Since you mentioned lawyers, there was a question about that. Like if I'm a founder and I'm creating the cap table myself, then why should I get a lawyer? Like what's the importance of a lawyer and how does it influence me?
The moment you start doing business transaction with third parties, which are investors or employees or anyone else, which is not just you, the founder, creating Excel or two founders and two lines in the Excel, the moment that's starting to be a communication with third parties, that means that there is a business agreement in between you. That means that in any case, there are going to be legal procedures and a process to get those transactions done. So by nature, you will find yourself speaking with lawyers.
Yeah, the other thing is, it really depends. I've worked for a couple of different I've worked for 3 investment funds in total in my time, and then I've dealt with many on the other side of the table. And I, have co-invested with a lot of funds and so on. So I've had a bit of exposure to how different each fund is. And what I can tell you, what I've learned is that there are some funds who are extremely founder friendly and founder first, and they pride themselves on that. And so you will see that their terms at pre-seed are really not onerous. They are very fair. Things like legal fees. So some term sheets will state that you pay for the fund's fees, right? So you do a transaction and your lawyers then communicate with each other. And the term sheet will say, but whatever our lawyers cost us for this transaction, you need to pick up that bill. Now, if that is the terms, well, then the fund could rack up 50,000, 60,000 in fees in that transaction because they choose expensive lawyers. And then, so whilst they might be investing 500,000 into you, you've now lost 50,000 in picking up their fees. There are other funds who don't need to do that, who don't want to do that. They say, we use a lawyer that we've used for a long time. The fee is 10,000 and we're going to pay that ourselves. So this is just to highlight that there are different types of terms that investors will put in. And unless you have a lawyer, a legal representative, you might not know to A, look out for those, or B, how to negotiate, and so on, because often it's not explicit. But anyway, you must work with a lawyer. But a good lawyer will be able to help you see what kind of fund that fund falls into.
Great, thank you. We have time for 2 more questions. So I'm sorry we couldn't get to everyone's questions. There's still a lot more. But should you be using a different cap table style depending on which stage you're at, or is it pretty standard? Like, for example, is there a different one that I would use for a pre-seed versus a Series A round?
It just gets more complex. You can use the same. And so companies use all different types. Some have it all lives in an Excel sheet and they update it every time they have investors. Honestly, I would have a preference that you use a platform because it will update it for you every single time and it's one source of truth, but you shouldn't be operating in different, you shouldn't have a cap table for your seed and then a separate cap table and separate document for your Series A. It's like your passport. It stays the same, if the 10-year passport, it stays the same. Doesn't matter what country you go to, it's the one document. It's the same with a cap table.
I love that example. That's great. Oh, Lee, go ahead.
Yeah, and the one that we shared over, it definitely has a lot more than is required for the pre-seed stage. So you'll be able to see other elements that, are generally incorporated at later stages. You don't have to use them. So for now, you might delete a lot of the rows. In the future, you'll just add them back up. As Georgie mentioned, the caps table is one document that you should always have, and you just add rows as you continue to grow and build.
And guys, just a note on this. So when you get to say like Series B, Series C, your cap table becomes part of like notaries and all these different things. So when you're sorry, I hope you guys can still hear me. Yeah. It actually goes to a lot of third parties. It can go to legal entities and so on. So one mistake that I found many times is that the founder gave the cap table to a very junior finance analyst in the business, and lots of hands, people churned, and ownership was pretty messy. That's a mistake, because I've actually seen some like very big financial penalties, because valuations and so on were incorrect due to a messy cap table. So as a founder, it's like it is your birth cert. You wouldn't just give your birth cert to somebody else. Keep it close, and make sure that you have a sense of ownership on it.
I would add another point, as you grow to round B, round C, and there are many parties in the cap table. There are also decisions that are made in a company with voting. Understanding how each of the parties in the cap table, what percentage that person or company has, is critical for your ability to pass decisions that need specific vote in the company, whether it's need 50% vote or 75% vote. You need to understand it in every single time, and having an organized cap table allow you to control and process those decisions faster.
I'm going to try to squeeze in one more question. So what are some, Georgia, you spoke to this a little bit, but what are some common mistakes that you see with cap tables that you would recommend for people to avoid or to prevent? And this is for all of them.
Gosh, there's many. I think so. Again, sorry, I really sound like I work fully for a cap table platform. They're great, by the way. But I I think when in Excel sheets, when people were kind of manually calculating stuff, I mean, manually Excel wise, they just have rounding up errors. And then that kicks off everything. I mean, when it's done there, it is up to the kind of, analyst, etc., who's working on it to go through with a fine tooth comb. And honestly, at pre-seed seed, it's simple, but then later on, when you're dealing with more shares, you're dealing with convertible notes, and yeah, things not being converted correctly. Also, you're then dealing with multiple share classes. So I think I would just say overall, it's not going through things with a fine tooth comb, and then the rounding up errors. I mean, even a 0.5 error can kick everything out. So that's why I don't love the Excel sheet one, maybe just because I'm not, I don't love going through in that much detail, because cap tables are, as I say, not my favorite place to hang out on a Friday. But anyway, yeah. Guy, did you have anything that you saw that was common error?
All the accuracy on the names, that was one of my errors, was the founder. You might end up with two investors saying that that line in the cap table belongs to them, which is not. Keep it accurate, keep it simple to manage, and plan ahead. I mean, that cap table is your, let's say, common ground with all parties to make decisions in the company. That's your future. It's okay to have multiple parties in that cap table. Make a decision that means that you find great investors, but be on top of it all the time, manage it.
Yeah, and I think
Yeah.
on that, so I think they're great points. I think the other thing with regards to, I'm talking about very detail orientated, like rounding errors, but actually on a more existential piece, the issues with cap tables is where founders gave away equity, like they gave away sweat equity to a design company to do something, and they didn't value how valuable their business was or could be, and they gave, way too much. Or they, for example, had an advisor. And by the way, I was working with one of our companies last week who an advisor, really big name, had sold his company for several hundred million, and he came into them before they joined Techstars, and he tried to negotiate a sweat equity, so where he gave advice in return for equity. And he really wowed them, and they very nearly signed it, but we actually stopped them from doing so because he was asking for an enormous amount of equity, and the term in this fine print was that he only needed to give 1 year's of work, and then he's gone. And so that massively dilutes the founders, and you already don't know how much he's going to move the needle. And it's very unlikely that in the first year that you could move the needle, 4% enough for a C company. So that's a really big one. Like, dilution is to be managed very carefully. The other one, I would say, another error on the cap table, again, goes to the right investor. If you have the wrong people on your cap table, they can be on your board. They can, even if they're angels, they have your phone number, they can be very loud, and if they're destructive to your business because you've chosen the wrong people, they can have a material impact. I've experienced it, I've seen it in many different angles. So that's another issue on the cap table. Like, you should have people on there who either have no voting rights and you're okay to just take their money, but if they have voting rights, they're the kind of people that you want to be dealing with regularly.
Great, perfect. That wraps us
Took
up.
the words right out of my mouth. With
Sorry,
the sweat equity.
Yeah.
No, I was saying, right as I was about to say, Georgie took the words right out of my mouth in regards to the sweat equity. It's not necessarily an error in creating your cap table, but definitely be wary of that. VCs may scrutinize if it wasn't for the right service, but then again, sweat equity is a common practice, especially if you're pre-raising funds. It's all about the storytelling and getting people on board for the sweat equity as opposed to paying them out. So, but just be cautious of the type of service. Usually it's less frowned upon if it's tech development, legal services, advisory roles, and so on, but not as they both mentioned earlier, some design company that wants 20% for 1 year's worth of work. Definitely look into the fine print there.
Perfect. Thank you all so much for this session. I could tell by the interaction with everybody and the questions and everything, this was a great session. So we hope all of the founders on the call were able to get something out of today's group. And also I'll send the recording afterwards, so you'll have access to that. But thank you so much for your insights, Guy, Georgie, and Lee. And lastly, I shared your your programs in the chat as well. But what is the best way for people to get in touch with your team if they're interested in learning more about your program? Is it through LinkedIn? Should they follow you on there? Should they submit an application? Anything that you want to add?
So Lee and I are going to be working pretty hard on this. We will be doing some kind of office hours, so please follow us on LinkedIn because we'll be posting about those, and you can dial in and join Q&As and talk to us in much smaller groups. And then please go to London Accelerator, the Techstars Accelerator, with the link is in here, and apply before November 20th. And then we will review and reach out and have a chance to talk. Even if you're on the fence, even if you're off the fence, just apply because you keep your options open and we can discuss it. You're not signing up to anything. You're not committing to anything by doing that. But it will be, no doubt, it's honestly an amazing program. So I would really consider it.
Perfect.
Yep, I put the link in the chat just now. So
thanks, Lee.
just click on that.
Awesome. Well, thank
Amazing.
you all. Yeah, have a nice day, everybody. And we'll see you at
Thank
the next event.
you.
Thank
Thanks,
you.
guys.
Bye.
Thank you.